Let's talk to Shaun Richards, not a yes man economics. A very good morning to you, young Shaun.
Morning.
Right, so I've read an extract first thing this morning. US Fed Governor Brainard says financial asset valuations are stretched as cyclical pressures are building. On your soapbox, what are your thoughts on that comment?
Well, there's various issues here. This comes through to some numbers that have been doing the rounds on the US economy. Some of you over the weekend might have looked at the Financial Times, which had a thing on Manhattan house prices, property prices, because of course a lot of that will be flats and apartments, as they put it. If you go through that, that's what you might expect. What do I mean by this? We're seeing that capital cities, and I'm including New York as a capital city there, even though it really isn't, international trends against them. There have been some tax law changes in the US, not particularly favourable for it. And of course, the US Federal Reserve, where we come in, is tightening monetary policy.
Yep.
So falling prices in Manhattan, not a surprise, although a lot of people were applying to that. It's hard to have a lot of sympathy for people when the average price is still $8 million. So there's that. However, when you look further, the situation in the US is quite different. And what I mean by that is, and now there are different measures and depending how you look at it, but on the Case-Shiller number, the growth is still 6% a year, a bit over. So not falling there. And we come back to the point of sort of asset valuation stretched. Well, they're getting more stretched. If we bring this back to how they measure inflation and how this works, something of a swerve's applied, and here's a debate as to which the Fed's really looking at. Like us here, they use rent. I know if you own your own place, you don't pay rent, but they assume that. This is what imputed rent's called. And here's the catch. Rent in the US, looking at the numbers according to Zillow, it has picked up, but the annual rate of growth is 2.8%. House prices, according to them, are 7.5%. So 6 or 7% compared to something less than 3%. This is something that's a big factor in US inflation and what the Fed looks at, because if you follow the system of assuming people pay rent when they don't, you keep inflation down. If you put house prices in, it'll be up quite a bit from where they are now. And so this is the sort of pull of policy at the minute. So if you look at inflation in the US, because I think last time I looked, shelter, as they classify it, is about 32% of CPI, so a third, give or take. This matters quite a lot. The rent numbers have been pulling inflation up, as it is, but if you put house prices in, they'd pull it up by a lot more. Then we'd have a different situation. So if you looked at it the other way round, which is that if the Fed is actually doing these numbers and implicitly putting house prices in, that's why they're raising. And so this brings us to sort of where we are. A lot of people may not understand why they're raising now with inflation below the thing, but that, in my view, is why.
Understood. So if you were working at the Federal Reserve, okay, what stance would you be taking? If the market's factoring in we're going to go to X, why don't they do it now?
I think they should. I would. I don't see any point messing around. Now, first time around, you'd have to be slightly careful because the trouble is the world now become so geared and so tight that if you did something like that, the shock effect could spiral out and you could have another credit crunch. If we look back, one of the problems of the initial credit crunch, if people remember what happened in the UK, was that interest rates went, in fact, as much as 2% over where the Bank of England was trying to set them. People may remember there were one-year bonds then offering 7%, when I think the bank rate in the UK was 4.5 or 4.75, so things shot over, and they did nothing like that. You could create that sort of situation, I'm not saying it's bad, again. So you'd have to signal it out. But I think it would be far better than responding to things now saying you're going to act all year, to simply do it. Put out a statement saying, in essence, this is it for 2018. And then go back home for a bit and think about it.
Okay.
So like last time round, for example, I'd have raised them to 2% in the States, put out a statement saying, that's it for now. See you in the summer or autumn or whenever.
Okay, so does it follow on that rates go up in the US? Okay, do rates have to go up in the UK?
No, ordinarily in the past what they have. What's changed since then Well, we have a Europe. Now, don't misunderstand me, because Europe was always there, but what I mean by that is there's a European Central Bank and a sort of euro area that is, these days, as much as a pull as the US. In terms of trade figures, more so. So there's an issue of it being a downwards pull. So if you looked at it like that, I suppose you'd argue that we should be following a bit. So say bank rate here should now be 1%.
So is the ECB more important than the Fed?
In trade terms, you could argue that. If you look at it in flows of other things like inflation, it gets more complex because, of course, commodity prices, for all the news, like there's been some news recently about oil being priced in yuan or some of it, in essence, it's a dollar game.
Yep.
And so that brings it back into play. So I'd say there's probably about an equal pool for us, in which case we should have raised rates, but we haven't.
Okay, so to wrap up, at times in the markets, okay, they're driven by the fundamentals, they're driven by the technicals, they're driven by sentiment, geopolitical, political. Okay, in terms of you being an economist, okay, how much of this is actually being priced into the market, or is this all almost forgotten about because the headlines are Trump, etc., etc.?
So which bit? Do you mean the US or
globally?
I actually think that US monetary policy, in terms of the raising, has been in there for some time. In fact, further than that, I think that one of the reasons for dollar weaknesses recently are people are pricing in the risk of QE4. I think QE4 is quite, I've argued this for some time, that the US could have entered on a road where it raises interest rates and returns to quantitative easing. Well, I know currently it's tightening,
okay,
but say we come to later this year, if the economy slows down, and remember we've had the Trump fiscal boost, so the numbers for debt could start to slip away, and we actually get some bond yields rising, very quickly, if you look at the numbers these days, that becomes unaffordable. So then the Fed presumably will step back in.
So a new round of quantitative easing by the Federal Reserve, you've obviously discussed this on social media, okay, is this acceptable policy? Or is everyone going mad at your mad idea?
No, people were when I was saying this a couple of years ago to some extent, because of course that was a long way ahead. Now, we see this in so many places, don't we? Like, for example, let me give you an example from Japan. We had the Governor of Bank of Japan, I think over the Easter break, Kuroda, saying that he was going to cut back on the stimulus. What happens yesterday, or was it the day before? Stock market drops like a stone, so the Bank of Japan borrows in and buys ETFs.
Right.
That's not a withdrawal last time I checked, is it?
So the put option below the market.
Yeah, and we keep getting that, don't we? All the things that people say couldn't happen on the stimulus side, we find that they can. And mostly they don't go away. Fed is extremely rare in taking something out, only a little bit. Give people a clear example. I wrote something in City AM, September 2013, saying the Bank of England should take back some of its QE. I don't mean the thing about not doing any more. I mean actually let bonds roll off so there'd be a smaller amount. But I mean this September, that'll be 5 years, won't it? And they haven't done anything, have they?
On that note, Shaun, we run out of time. Thank you very much for your time.